Corporate Comparative Analysis of Johnson & Johnson and Pfizer Incorporated, presented by Josh Rivera and Caitlin Sellier. Who are our shareholders? Johnson & Johnson currently has 2.77 billion shares outstanding, while Pfizer has 7.36 billion shares outstanding. The ownership of Johnson & Johnson and Pfizer are very similar. The top 10 institutions that are shareholders own about 1/4 of each company. The exact percentages are 21.7% for Johnson & Johnson and 22.1% for Pfizer. In addition, the top 4 companies that own the most shares are exactly the same. They are the Vanguard Group, State Street Global Advisors, BlackRock Institutional Trust Company, and Wellington Management Company. The only difference is that State Street Global Advisors is the top shareholder for Johnson & Johnson, and the Vanguard Group is the top shareholder for Pfizer. The remaining institutions on the list are mostly the same as well, but the ranking order differs between the two companies. Why do investors care about our capital structure? Capital structure is important to investors because it influences the risk involved with the investment. The capital structure of a company is the amount of debt and equity that is used to finance the company. There is usually more risk involved with companies that carry a larger amount of debt than equity. However, a company that does not utilize debt may be missing opportunities to grow their business. These are some of the advantages and disadvantages of debt and equity. Advantages of debt. The company maintains ownership because lenders are loaning capital and do not have the interest of an owner in the company. The owners retain a larger profit because lenders are only paid what they are owed and do not share in these profits. The amount paid to lenders is consistent, and the interest portion of these payments is tax deductible. The firm may be more motivated to be successful because the cost of bankruptcy is higher. Disadvantages of debt. Debt has to be repaid, and the interest costs may be high and difficult to pay in periods of negative or slow growth. The company has higher risk when debt is used to finance operations. Probability of default is higher, and the cost of bankruptcy is higher. The more debt a company has, the harder it may be to obtain more financing from debt, so they are limited in their options of financing. Investors may stay away from riskier investments or pull their money out when firms increase their debt. There are also factors that influence the optimal debt ratio. Some of these are tax rate, ability to pay interest, variance in operating income, default spreads, and firm projects. What is our cost of debt financing? The pre-tax cost of debt can be calculated by adding the default spread to the risk-free rate for each company. The current risk-free rate as of February 6, 2013 is 2% according to the 10-year Treasury bond. The default spread for each company can be found using Modron's table comparing bond ratings and default spreads. According to Morningstar, Johnson & Johnson has a credit rating of AAA and Pfizer has a rating of AA. The correlating default spread for Johnson & Johnson is 0.4% and the correlating default spread for Pfizer is 0.7%. These are added to the risk-free rate to calculate the pre-tax cost of debt. For Johnson & Johnson, this number is 2.4%, and for Pfizer, this number is 2.7%. To incorporate taxes, these numbers must be multiplied by 1 plus the tax rate. Johnson & Johnson's tax rate is 23.7%, giving them a cost of debt after tax of 1.83%. Pfizer's tax rate is 21.2%, giving them an after-tax cost of debt of 2.13%. What is our cost of equity financing? The cost of equity financing can be found by using the capital asset pricing model. According to this model, the cost of equity equals the risk-free rate plus beta times the market risk premium. The risk-free rate is 2% and the market risk premium is 5.5%. At a beta of 0.54, Johnson & Johnson's cost of equity is 5.94%. At a beta of 0.72, Pfizer's cost of equity is 7.92%. What is our overall cost of capital? The cost of capital is the weighted average cost of equity, debt, and preferred stock. This table calculates the debt ratio, equity ratio, and preferred ratio for each company based on the financial information listed. It also lists the cost of debt, cost of equity, and cost of preferred stock. The cost of preferred stock is 0 for both companies because Johnson & Johnson does not have any preferred stock and Pfizer does not pay any preferred dividends. The weighted average cost of capital for Johnson & Johnson is calculated to be 5.63%, and the weighted average cost of capital for Pfizer is calculated to be 6.97%. Could we lower this by changing our capital structure? For Johnson & Johnson, increasing the debt ratio from the current level to the optimal level would decrease the weighted average cost of capital by 0.01% and in turn increase the value of the firm. For Pfizer, decreasing the debt ratio from the current to the optimal level would actually increase the weighted average cost of capital and decrease the value of the firm. How would a financial restructuring affect the value of the company? Johnson & Johnson is almost at the optimal debt ratio. If they were to increase their ratio from 9.04% to the optimal 10%, they would increase their value of their firm from about $194 billion to about $194.5 billion. This is an increase of about $500 million. For Pfizer, decreasing the debt ratio from the current ratio of 23.61% to the optimal 10% would decrease the value of the firm from about $170 billion to about $168 billion. This is a decrease of about $2 billion. Would more debt create unnecessary risk? Increasing the level of debt would not create unnecessary risk for Johnson & Johnson. The value of their company would increase, and they would also benefit from all the advantages of using debt to finance the company. The increase in debt would increase the probability of default, but only slightly by 0.1%. The bond rating would decrease only slightly from AAA to A+. Increasing the level of debt would create unnecessary risk for Pfizer. Because the debt ratio is already above the optimal debt level, they would not benefit from further increasing the amount of debt they carry. An increase in debt would decrease the firm's value and increase the probability of default significantly and decrease the bond rating significantly. They would have to deal with all the disadvantages of carrying above optimal debt. What does the competition do? As represented by the bubble graph, the companies in the industry are very close in terms of liquidity. Market capitalization of all four companies vary, but long-term assets of Johnson & Johnson and Pfizer are comparable in the 60% range, while Covidien and Novartis are comparable in the 70% range. Shareholders' equity is not quite comparable for all four companies. Novartis and Johnson & Johnson are more comparable with the 50% range, while Covidien and Pfizer are in the 40% range. The difference can be seen in the long-term liabilities category. Johnson & Johnson and Novartis are comparable once again in the 25% range, while Covidien and Pfizer are in the high 39% range. Pfizer has the highest rating of long-term debt and total liability, while Novartis was near the bottom, followed shortly by Johnson & Johnson. Is our stock price fairly valued? The fair value of a stock is open for interpretation, and there may be more than one answer to what this fair price is. To evaluate how fairly priced the stock of Johnson & Johnson and Pfizer are, we will compare the market price to the price we calculated in our analysis, as well as the average price of three valuation methods. The three valuation methods we used were the price-earnings method, the dividend discount model, and the zero growth model. The results from the analysis and the three valuation methods are shown here. Johnson & Johnson has a market price of $70.10. The average of the three valuation methods we used was $59.75. In our analysis, we found the price to be $63.69. For Pfizer, they have a market price of $24.86. The average of the three valuation methods that we used was $17.43. In our analysis, we found the price to be $17.68. According to the results of the analysis, Johnson & Johnson and Pfizer stock are overvalued in the market. In addition, the results from the valuation methods of the two companies also show that both companies are overvalued in the market. Because both companies are overvalued, the decision of which company is the better investment will be based on the company that pays a higher dividend and is growing positively. We choose Johnson & Johnson as a superior company.